Joining me now is Oxbow Advisors Managing Partner Ted Oakley. Ted, great to see you. Thanks very much. We will finally get a real window into the first quarter from corporate America and get their guidance for the rest of the year. What are you expecting?
Well, you know, Maria, we've been expecting lower numbers from in the general. We're expecting that. We'll have some companies that show up, but in general, we think the first quarter, second quarter are going to be lower earnings for companies.
You think they're going to be lower for companies? Yeah, FactSet is expecting a decline of 6.8%. But what are you expecting in terms of the guidance from managers? Do you think that we'll hear cautiousness for the year ahead? What do you see the macro story playing out?
Well, Maria, as you know, they will probably paint the picture the way they want to. But the problem is the facts are going to show that business is slowing down, and they're going to have to come forth and say that, you know, it's going to get worse for them. Hopefully, you know, they'll come straight through. But I think that's the thing you get into here is they will, you know, they'll lower expectations. But in absolute year to year, they're down worse than they will probably talk about.
So what do you think, Ted? Do you think we'll see a recession later?
I do. I think you're set up for it. I think it's a slow moving to get there. But I think we're headed in that direction, yes. Well,
and yet the Fed keeps raising interest rates. We're expecting another hike on May 2nd and 3rd, the next two-day meeting from the Fed, just a couple of weeks away. Treasury Secretary Janet Yellen spoke yesterday about the impact of the banking crisis and leading to higher, whether we are going to see higher rates or not. Here's what she said, watch.
Banks are likely to become somewhat more cautious in this environment. We already saw some tightening of lending standards in the banking system prior to that episode, and there may be some more to come. And that does tend to lead to somewhat greater restriction in credit that could be a substitute for further interest rate hikes that the Fed needs to make.
Ted, what do you think? How significant will these rate hikes be?
Well, you have to think about it, Maria. If you look at it, if they go a quarter here in May, that puts you at an 8 1/4 prime. So if you're a borrower at prime plus 1, you're 9 1/4. So you better be making good money in your company if you're borrowing at 9 1/4. I think that's where this all plays in. All of a sudden, you really start to slow down the borrowing side. And if you take all this leverage debt we have everywhere, tremendous amount of leverage debt, then all of that starts to go higher, as well as leveraged real estate that's floating. The whole thing plays in together, and I think that's why we see the recession here.
Well, I mean, we have a tightening of credit for sure. Has that changed the way you're allocating capital? We see banks tightening right now.
We do. You know, I'm involved in a community bank myself. But the thing about it is that what we're seeing now, we moved about, probably 15% of our bond portfolio into the long bond treasury because we really feel like it's probably peaked. The short end, no. But, and maybe it stays high for quite some time. But in time, you know, it takes care of itself. And I think that's where we are now.
All right. We will leave it there. Ted, it's good to see you this morning. Thanks so much.
Hello everyone. I just want to say if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe and you'll see more of what we do here at Oxbow.